Everyone knows Amazon as a retail empire, shipping billions of packages worldwide. But examining the balance sheet reveals a very different reality. In 2024, its North American retail operations generated roughly $315 billion in revenue. International operations added another $135 billion. By contrast, Amazon Web Services, the company's cloud computing division, has a much smaller footprint. This Sankey diagram maps Amazon's revenue. Retail creates massive cash flow, dwarfing the cloud division. But operating income flips the hierarchy. Retail shrinks, while AWS expands to 71% of total profit. AWS operating profits flow directly back to subsidize the retail logistics network. AWS acts as a capital engine. It covers the overhead, allowing Amazon to permanently decouple its retail pricing from immediate market realities. This architecture traces directly back to Jeff Bezos' 1997 shareholder letter, the document that established Amazon's corporate strategy. The text outlined an explicit mandate. Amazon would prioritize long-term market leadership and scale over short-term corporate profitability. In practice, establishing scale meant pouring revenue back into physical infrastructure and systematically lowering prices to attract customers. Public markets usually punish this behavior. Wall Street expects retail companies to return predictable quarterly dividends, not operate at a perpetual break-even point. The explosion of cloud computing profits provided a shield. AWS generated the massive cash flow required to keep Wall Street satisfied. Operating the retail division at near-zero margins became a permanent structural condition rather than a temporary customer acquisition phase. Amazon's retail losses are a feature of the system. They provide a debt-free method of market expansion, authorized since day one. Amazon translates this AWS capital into an operational loop known internally as the Amazon flywheel. This diagram illustrates the mechanism. It begins with investments to elevate customer experience through lower prices and faster shipping, driving increased traffic. That volume exerts a gravitational pull on third-party sellers, rapidly expanding selection. This scale drives down the logistics network's fundamental cost structure. Those savings feed directly back into lower prices, accelerating the loop. Every rotation of this wheel requires significant capital expenditure. The high-margin profits from the cloud engine keep the wheel spinning. Yet, the mechanism has a strategic vulnerability. It requires customers to repeatedly choose Amazon over competitors for their next purchase. To lock in that momentum permanently, Amazon needed a way to capture a customer's total lifetime value. In 2005, Amazon launched Amazon Prime, a program that defied standard corporate quantitative analysis. The subscription fee was set at $79. The number was chosen as a psychological sweet spot, high enough to require commitment, but low enough for users to experiment, rather than a calculation to recover shipping costs. This visual ledger compares the economics at launch. The $79 collected from a subscriber was weighed against an estimated $160 in annual shipping costs for a heavy user. Financial models projected that scaling this program could result in $1 to $2 billion in annual losses. The true objective was behavioral. Prime was engineered to shift consumer reference points. By sinking shipping costs into an upfront yearly fee, the psychology of online shopping changes. Consumers feel they are losing money if they buy an item elsewhere and pay for shipping. This aligns with the day-one philosophy of customer obsession, inventing a benefit before the market forces the company to do so. Competitors were suddenly forced to offer free shipping to maintain their customer base, but they lacked the AWS profit subsidy required to absorb the resulting losses. Prime operates as a behavioral moat. It is financed by cloud computing to ensure absolute retail exclusivity. With a moat established, Amazon transitioned to offensive tactics. In 2010, the target was a startup named Quidsy, the parent company of Diapers.com. Quidsy had successfully optimized logistics for bulky, low-margin items like diapers, a category Amazon had historically avoided due to shipping complexities. Amazon deployed a secretive internal group known as the Competitive Intelligence Unit to study the threat. They ordered massive quantities of goods from Diapers.com, methodically reverse engineering Quidsy's shipping metrics and overall volume. Before initiating a price war, Amazon systematically maps the operational and financial vulnerabilities of its target. Amazon presented Quidsy's founders with a buyout offer. The founders refused. Under the active price war phase, Amazon deployed algorithmic bots to perfectly track Diapers.com, dropping prices up to 30%. Escalating to a fulfillment confrontation, they launched Amazon Mom with free Prime and another 30% discount, accepting a $100 million quarterly deficit purely on diaper products. This severe margin destruction panicked Quidsy's venture capital backers, starving the startup of the operational cash it needed to survive. This was a mathematically precise war of attrition. Victory is guaranteed to the combatant with cross-subsidized capital reserves. Facing collapse, Quidsy sought an escape route and secured a $600 million bid from Walmart. Amazon's negotiators responded by promising to drop diaper prices to absolute zero if Quidsy aligned with Walmart. Fearing total market destruction during a protracted regulatory review, Quidsy capitulated. They accepted Amazon's lower bid of $545 million. This exact acquisition triggered a severe regulatory backlash. As detailed in the Yale Law Journal, it became a textbook case study for modern antitrust scrutiny. FTC Chair Lina Khan built her legal framework around the tension inherent in these practices, specifically targeting Amazon's pricing tactics. Amazon defends its methods as the pinnacle of customer obsession. Antitrust scholars classify monopoly. 20th century antitrust laws measure monopolies by high consumer prices. They struggle to prosecute a company that leverages temporary losses to expand its dominance. Amazon has engineered a unique financial architecture that allows it to deliberately sustain retail losses over years rather than quarters. By using cloud profits to subsidize its retail operations, it transformed the act of losing money into a sustainable, strategic path toward market dominance.